Welcome to the Deep Dive. Today we are taking a really close look at the London property market for 2026. We're going to use expert forecasts and hard data to understand what's moving the market out of this long, sticky patch and hopefully back towards some kind of stability.
And that stability is so desperately needed. I mean, the market has been fundamentally clogged up. In 2024, we saw transactions just plummet to about 75,000. That's the lowest it's been in over 20 years.
20 years. Wow. So how does that number compare to, a normal trading year? What does that tell us about how gummed up things really got?
It tells us mobility just seized up entirely. I mean, that 75,000 figure is even lower than during the 2008 crash.
Really?
Oh, yeah. And this paralysis, it hasn't just forced people to adapt, living with parents longer, squeezing into house shares. It's also created a massive financial headache. We're talking about an estimated £4.4 billion in lost stamp duty for the Treasury.
Okay, so let's look forward then. After 5 years of, disruption, what are the early signs that point to a steadier 12 months ahead?
The signs are really pointing toward improving affordability. And that's driven by two key things: prices and interest rates.
Right.
So prices in London are already down 5.1% from their post-COVID peak in 2022. And for the first time in a while, wage growth has actually started to outpace house price growth.
But the big one is interest rates, I assume.
That's the most critical factor, yes. The expected Bank of England base rate cuts.
Okay, so those cuts follow that December reduction. But what kind of impact can we realistically expect in 2026?
A pretty significant impact, actually. The general market view is that inflation has peaked, so more aggressive cuts are on the table. We're even hearing one major mortgage broker forecast that we could see mortgage offers drop into the twos by next summer.
Into the twos? I mean, that's a huge psychological boost for buyers, isn't it?
It's massive.
But even with that possibility, the agent forecasts seem remarkably conservative. Why is the outlook still so, cautious?
Well, because the market is still structurally constrained by supply. The lack of new housing is still the root cause of the problem.
So that's the ceiling on growth.
Exactly. I mean, look at the predictions. Savills is forecasting 0% growth. Rightmove is saying maybe a 1% rise in asking prices. And Jackson Stops is only going up to 3%. It suggests the return to the market will be more of a trickle than a flood.
Okay, so if the long-term issue is the housing supply, what's actually being done to, loosen that constraint?
We're starting to see attempts to fast-track new builds, mostly by reducing some of the financial demands on developers, specifically around affordable housing requirements, which has been a huge sticking point. And we're also seeing a default green light for new homes near, say, railway stations and high-rise buildings.
And if people are still priced out of their usual areas, where are they finding value now? Where are they moving?
There's a very distinct shift happening. We're seeing movers who are priced out of northeast London, places like Hackney, Stoke Newington. They're heading southeast, following a pretty well-trodden path to emerging pockets like Brockley, Honor Oak, Ladywell, and Nunhead.
And what's driving the activity there? Is it just families looking for more space?
It's definitely families, but it's also massive corporate investment. You've got Visa relocating their European HQ to Canary Wharf. JPMC and Deutsche Bank are also doing major expansions.
Okay.
And that influx of corporate capital just fuels demand in those southeast commuting corridors. The demand is ferocious. We heard this one anecdote about a 1930s house in Brockley that got 20 offers.
20 offers. Unbelievable. Okay, let's pivot from those local hotspots to the very top of the market. Because there's a big wild card coming in 2028, the mansion tax. That's a proposed £2,500 annual levy on homes over £2 million.
Yeah, and what's fascinating here is the paradoxical effect this tax might have. It's set to hit pensioners the hardest, people who've seen their property values soar over decades. Yeah. This might actually increase sales volumes at the high end by pushing these homeowners to downsize.
So it could accelerate moves they were already thinking about. But the real pain point has to be the logistics, right? How do you even apply it? A 5-yearly valuation, but without the time or money for internal inspections.
Exactly. The original 1991 council tax valuation cost a fortune for what were basically drive-by assessments. So this new system will probably have to rely on automated valuations, maybe using data from property portals or even drones.
Drones, really?
It's a possibility. I mean, if you look at what happened in Greece with a similar assessment, you had people literally covering their swimming pools to try and keep the valuation down. It just shows you how difficult accurate external valuation is.
And the appeals process would be a nightmare.
Long and very, very expensive.
That's definitely the key friction point to watch.
Yeah.
So the summary seems clear. 2026 is a shift towards stability, driven by affordability, but is all limited by that slow housing supply.
Yes, and if we connect this to the bigger picture, it raises an important question. If this five-yearly mansion tax valuation relies on these inexact methods, automated models, what confidence does that give homeowners who are thinking about a move? And just how messy will that inevitable appeals process be?
That's definitely something for you to mull over. And here's a final thought for you. If these new construction efforts focus so heavily on high-rises near railway stations, how quickly can the social infrastructure, the cafes, the schools, the independent shops catch up to create that urban village feel that people are chasing in places like Broccoli right now? That's the real long-term challenge.